We actually are very, very positive, perhaps even bullish about the technology M&A market for 2014. We kind of see it as two broad tailwinds, if you will, that we think are really going to sweep and drive transaction volumes and values, frankly, overall. The first is really just the macroeconomic trends, right? If you look across the industry, the liquidity is really strong. CEOs in our recent survey have reported pretty high confidence, certainly higher confidence than any of the last 3 years relative to growth prospects. They've also signaled an increasing confidence in using inorganic activities, M&A, divestitures, and so forth, as one of their key levers for driving growth and shareholder value. So from a macroeconomic perspective, the conditions are ripe for strong volumes and activity. If you look at it from a sector kind of trends and drivers perspective, you have a convergence of a similar phenomenon. First off, we've got this sea change in the technology industry that's taking place. On the consumer side, it's really through mobility and the convergence of computing and entertainment and communications all across these fantastic smartphones and other mobile devices that consumers are increasingly using. And we're seeing so many things converge on those devices and so many markets opening up that's really driving a lot of very, very strong transaction volumes at the low end, as well as some of these large, headline-making transactions that we're reading about at the higher end of the value stream. On the enterprise side, we're seeing a dramatic shift into what everybody's calling cloud, but really as a phenomenal change in business model. I mean, if you think about it, it's effectively going from an ownership or product-based business model to really a rental or service-based business model. And those companies that are shifting more rapidly are taking market share. A lot of them are going public, getting phenomenal valuations, encouraging more and more investment in the sector, and really creating some shakeups and competitive dynamics that are difficult for some of the long-standing incumbents. And there's been a lot of debate and really different schools of thought in and around what really comprises an effective M&A process or an effective acquirer. I would say over the last 10 years, there's been a big shift towards integration, really on the execution side. And so companies have invested a lot in putting together effective M&A integration teams, as well as hiring outside advisors like us to come in and really help them, especially with larger transactions. And our point of view on that is that there's really kind of 4 key things that companies need to do. And they need to get into the detail around the baseline of the target they're acquiring. So if you look at most acquisitions, they've got a premium of, say, somewhere between 20 and 40%, which reverse engineered means that well over half, and in many cases more than 3/4, the value of that transaction is really in the baseline existing business that you're buying. So you have to get in there and do a lot of diligence, and that's where we really help our clients a tremendous amount to get in and sort through what are the things within the company's results that distort their trends or that may not be recurring once acquired by our client. Very critical to get that baseline right. The second key thing to focus on is the synergies. So that's what ultimately justifies putting a premium on an otherwise fairly valued company. And our point of view on that is that companies need to do a lot more work around this. The third thing they need to focus on is enough integration planning to be able to answer some basic questions when they announce the transaction. How are we going to integrate it? Where's it going to fit within our organization? Who's going to lead this? How is it going to affect customers and employees and vendors? And then also, and very importantly, what's the cost of that integration? So especially in large transactions, it's not unusual to see that the integration costs, so the costs associated with reductions in workforce, closures of redundant facilities, renegotiation of supply agreements, those costs can sometimes exceed 20% of the overall value of the deal. The last area is really what we call the red flags or the risk management. So what are the things that could just absolutely destroy value in a transaction? Is there litigation? Is there underlying concern about the value of the intellectual property? Does the selling company actually own that? Is there an enormous risk associated with retention of key employees? So those are the 4 key things we tell our clients to focus on from a diligence perspective.